It is Thursday, October 3rd, but before we go ahead and get into anything at all, let's go ahead and get our disclaimer out of the way. As always, everything we discuss today is solely my opinion, not the opinion of Trading Options Network. So do with the information which will take responsibility for your actions, please. Of course, also be sure to like, follow, or subscribe on your favorite social media network. And that being said, let's get into it. All right, so actually let's go ahead and start looking at the map. As you can see, it's pretty red today. Tesla's down kind of big. Nvidia's up actually kind of big. I haven't even really checked Nvidia at all today because I don't have a position in it, nor do I have a position in Tesla. In fact, I don't really have many positions open at all right now. However, if you do follow me on social media, you will notice that I did put PM, that is Philip Morris, on my watch list yesterday for a breakdown to open up a nice, quick, short, bearish position, and that's exactly what it has done. So we'll get into that here in a second. If we go ahead and look at the S&P ETF, as you can see, we haven't really done much today. Went up a little, went down a little. In the end, we're kind of where we're at, where we opened. We did gap down just a little bit today, but again, not a lot of movement, and I'm not surprised. As I had mentioned yesterday, I don't think we're going to see a very much volatility this month. I think a lot of people are just waiting until the election, see what happens. Personally, I really don't think it really matters who is actually elected once the election comes, but I think that really is going to be the biggest volatility changer, I guess you could say. And speaking of volatility, we're actually going to go into that in a little bit here as well. The consumer staples, why do I have this open? Well, the reason I have this open is, of course, because, as I had mentioned yesterday, my stock of the day was Philip Morris, and Philip Morris comes from the consumer staples sector. I had mentioned on the stock of the day that I was expecting a little bit of a pullback from the consumer staples sector, and I was expecting Philip Morris to follow it. And sure enough, that is exactly what is happening. So as you can see, Philip Morris gapped below the 50-day moving average yesterday and gapped down just a little bit, but since it opened, it just continued moving down. So I had actually opened up a nice diagonal spread. I believe it's not this Friday, but the following Friday is the expiration for the short legs, and it's going to be the November expirations for the long legs. Now, am I going to hold into November? Highly, highly unlikely. I do have a 117 target on that, a 117 target. So if it hits 117 very, very quickly, what I'll probably do is just adjust it and hope to ride it down a little bit lower. But if it takes its time to get to 117, once it does hit 117, I'll go ahead and close the entire position. And of course, if tomorrow it decides to reverse and start moving back up, I should be able to still close it. Unless it gaps up significantly, I should be able to close it for a small profit still. So we're looking pretty good with this one right now. I think we are going to go see 117, if not a little bit lower, possibly even down to, we had a little bit of support / resistance here at about the 113.50, we'll call it, level, just to make it a nice even number, around 113.50. So heck, it can actually go down all the way to there pretty easily. So again, if we hit 117 pretty quickly, I'll probably adjust it where I close maybe, half of my long legs, but all of my short legs. We'll see what happens. But moving forward. Yesterday, the tip of the day was use volatility to your advantage. And starting today, I'm actually really excited that from now on, now you almost have a reason to follow me more on social media, because every single day I'm going to do a tip of the day, and then the following training for all of my wonderful subscribers is going to be a more in-depth training on that tip of the day. Only you get it. Nobody else gets it. But that being said, let's go ahead and get into a little bit more of the training when it comes to volatility. So what is volatility? Volatility is simple. It's an expected move in a stock or a security from the market. Okay, what the market thinks a stock or security is going to do. So what does that mean? Well, let's actually, I don't even think I have, no, I don't have it open. I was going to open up Thinkorswim really quick. I could still do that, I guess. But while I'm doing that, there we go. All right. Give me a second here. There we go. It should be popping up here, at least for me to log in here in a second. If you have the Thinkorswim platform or the app, you know it does take a minute to load. But again, what exactly does volatility do when it comes to options? Well, volatility has a huge impact in the premium of an options contract. So if the volatility is really, really high, that means the market expects the security to move a lot. And if they're expecting the security to move a lot, then the premium is going to be higher. On the flip side, if the volatility is low, that means the market as a whole does not expect this particular stock or security to move very much. And because they don't plan it to move very much, the premium will be relatively low. Okay? Case in point, and Thinkorswim is really taking a long time right now. It's still loading. Give me a second. But case in point, if we think back in, was it 2021 when AMC and, of course, gosh, why can't I think of it? GameStop, when they just started taking off, there was so much money made in options and, just holding the stock itself. There was so much money made, but there was so much more money that could have been made if people knew how to become net sellers, or what I like to, what I like to do a lot of is covered calls. I really do enjoy doing covered calls on my longer positions. And if you haven't seen my training, oh my gosh, are you serious right now? It's wanting me to do this 2-step security thing. So give me a second here while I do this. Oops. All right. Oh my goodness gracious. All right. Hopefully, there we go. Now it says it's logging in. All right. So again, if I was talking about covered calls, if you have not seen my training on covered calls, I'm sure I'll probably do another one here in the future, but I do have one on my YouTube channel that talks about covered calls quite a lot. I could probably get rid of some of this stuff. I'm not using that anymore. Yeah, I'm not even going to use this chart anyway, so let's go back to GameStop. Why is my keyboard not working all of a sudden? There we go. All right, so all the way back to GameStop. You can go back, obviously, a lot further than this. 3 years, 1 day, is that far enough back? Not quite, actually. Oops. Well, we'll get there. I'll continue to talk while I'm doing this. So when GameStop was just going absolutely nuts, if you wanted to buy a call option, you were going to be paying so much money for a call option. That's assuming you're trying to get that call option after it already started shooting up. Okay, but if you tried to do that, it would have been so much money because people were expecting it to continue to move, tens, if not hundreds of dollars, which it really did. It actually did. It did jump hundreds of dollars. All right, so is that working a little bit? It's a little bit better. Same thing with right here. In fact, let's just zoom into that one right there. And we'll go back and look at the think back here in a second as well. But let's say you had call options here, okay? They're going to be relatively cheap, okay? The stock isn't doing anything. There's no real expected movement, Okay, so if you bought call options here, they would have been relatively cheap. And we'll go back, like I said, we're going to look at the think back here in a second. However, if you tried to buy a call option here, it would have been astronomically expensive. So let's go see if we can find that here. All right, analyze, think back. Let's go to GME. What was that date, by the way? Let's start on April 30th. April 30th. Well, let me just type it in. I'm sure I probably could, but all right. So April 30th. Oh gosh, I don't need that. Let's get rid of that. GME. All right. So on April 30th, let's say we wanted to look at, I don't know, we'll go with the June expirations. Okay. I don't remember when the split was. I want to say the split was actually after this, but maybe it's not. But anywho, if we wanted to, on April 30th, buy a June expiration call, okay, and I'm just going to use this $12 strike as the example. I think, again, the split was after this, I'm pretty sure. But it's obviously the think back is adjusted from it. It would have cost a whopping, we'll call it, the bid-ask spread's 152, 166. That's 14 cents. So we'll add 7 cents, about $1.59. Okay, we'll make it $1.60 just to make it a nice even number. Let's say it costs you $1.60, okay, to go ahead and buy this call option on April 30th. Now, let's fast forward from April 30th to May 13th, so 2 weeks. Let's just go day by day and see how this premium starts changing. You can see the premium right here. It says $1.59, as I had mentioned a minute ago. Let's see how that starts changing as we go to May 13th. So on May 1st, it's about the same. May 2nd jumps up a little bit. May 3rd, now we're jumping up quite a bit more. So May 3rd, by the way, would have been this day right here. So it was a nice green bar right there. So absolutely should have jumped that day. Oops, didn't mean to do that. So used to FinViz now. Let me just go ahead and grab my little finger there. Now I can move it more. All right, there we go. So here's May 3rd. So it's a nice day, nice green bar. Okay, so yeah, we should expect it to go up a decent amount that day. Now let's keep moving forward. So May 4th. What was it? The $12 strike. Now we're at $5.50 to $6.50. Okay, so we'll call it a $6 premium there. Okay, as you can see, it's still the same. June 24th, $12 strike. Okay, this is what day? I believe this is May 4th now. So from August 30th, I'm sorry, August, April 30th to May 4th. If you had bought this call, you would have been looking really, really good. Now, what exactly has the stock done though from April 30th? Okay, on April 30th, it closed at 11.09, and on May 5th, it closed at 16.31. Okay, so that was a heck of a gain, heck of a day. Okay, but is it really worth, what did we say, a $6 premium? I mean, probably not. That gives it a break-even point of $17. So technically speaking, even though you're in the money, you're still in the red. You're not even to your break-even point yet. So that's one example of what volatility does. But let's keep moving forward. Okay, so we go a few more days. It looks like the volatility starts dying down. So I would not be surprised if we move forward a couple days and the premium starts dropping, even though the stock isn't really dropping. So let's see what happens here. So here's May 5th. May 5th is a non-trading day. All right, May 6th. So as you can see, it dropped. It dropped. However, let's see, May 5th, we closed. What did I say we closed at on May 5th? I guess, sorry, I guess May 5th was also non-trading day. I mean, May 4th. So May 3rd, we closed at 1647. Nice run. Then May 6th, we closed at 1631. And May 7th, coincidentally, we also closed at 1631. So we closed the same day, okay, from May 6th to May 7th. Okay, so here's May 6th, $12 strike between 5:30 and 6. Okay, that was the bid-ask spread. May 7th, 485 to 550. Oh, that's I'm sorry, that's the 13. So 5:30 to 6 again. Okay. And then the next day, 5 to 6:05. What did we do the next day? The following day? Close at 1592. So we did actually drop a little bit, but notice how much the stock itself dropped. I mean, the premium dropped. Okay, this premium dropped from $6, and that was the midpoint of the bid-ask spread, to about 550. Okay, the midpoint of the bid-ask spread. So it didn't drop much, but the premium dropped almost 10%. Okay, let's look at the next day. Let's go back to analyze. And let's see, 5.9. Now it's at 480 to 560. Okay. And we finished at 1592. Looks like these are a day off now that I'm looking at these and comparing them and everything. Because this right here is May 8th. And on the analyze, we are on May 9th. So this is probably the opening numbers, I'm guessing, on the think back. But nonetheless, you would think they'd be the closing numbers. I don't know. But anyways, here on May 8th, when it closed at 1592, if we go from May 8th to May 9th, it went from a 5.605 bid-ask spread to a 4.8560 bid-ask spread. So it dropped. However, the next day, obviously, nice green bar here, closed at 18. Let's see how much that affects the premium since that volatility moved a lot. All right, now we're at, suddenly, 635 to 735. So we're back up. And then we go one more day. Oh, non-trading day, boom. Now suddenly we are at a 1765 to 1955 bid-ask spread. So we're suddenly at about an 1860 midpoint. But what are we doing? Where are we at? We're closing at 30.45. Okay, so it's an $18 roughly difference between your, what do you call it? Between the strike price and the stock price. It's an $18 difference, but we're looking at well over an $18 premium, 1860 midpoint. I mean, we're talking about something that's so far into the money, yet it's still going to cost you more money, like a ridiculous amount of money just to get into it. Now, don't get me wrong, it should be at least $18. But I mean, if you wanted to honestly sell that, you couldn't even sell it because it's so expensive. Okay, then what happens the next day? Oops, analyze again. And now that $12 strike is it's broken apparently. There we go, 35 to 38. Yeah, so jumped even more. Okay. Now, obviously, you know, it's so far into the money, your delta is going to be almost 1. Okay. But now let's go ahead and take a look at some at-the-money calls. Okay. That expire the same day. Remember, we bought this one for, what did we buy it for? $1.59. Let's go ahead and see what an at-the-money call would be now. If I can even find an at-the-money call. Let's see, what day are we on? We are on May 15th, so that'd be this day, I believe. Oh, that's the, okay, so let's go back really quick. It closed at $48.75. Of course, I can't even look at one from that day. It's not even wanting to show it. Here, I wonder if I can, I'm going to cheat a little bit. I'm going to pick this one, the 40, but I'm going to go ahead and change that to a $50 strike, not traded. That's really frustrating. I don't know why they wouldn't be available, but that being said, this is, of course, the simulated trade, the paper trade. And I wonder if it's just not showing on there. I mean, I would imagine they were available. But you get my point. You get my point. When things start moving crazy, the premiums are going to start jumping like crazy. Unfortunately, we ran into a little bit of a snag here. Go figure. Where it's showing that it's not traded. I can't even do the 41, I don't think. Nope. So even though it does say all right here, I guess 40 was the highest strike for whatever reason. I wonder if I were to switch over to the actual trade and if it would change it. But nonetheless, that is what implied volatility will do. I'm trying to think of the FOMC meeting, for example, is another great idea of one. Okay, if you were to watch the FOMC meetings, okay, and I don't think I could do a think back for like a minute chart or a 5-minute chart or anything like that. But if we were to go back, let's go ahead and look at the SPY again. Okay. Hope you like my sound effects here. All right, why is it so big? That's what she said, right? Anyways. All right, let's get rid of some of this stuff here. Delete. All right. So the FOMC meeting was right here. That was what, May. I'm in May. Gosh, now I'm back in May. September 18th. So on September 18th, if I can do 15-minute chart, do a customized list. I don't see any minute charts on there. Add a time frame. I guess the shortest one it'll let me do right now is 1 hour. Oh my gosh. Oh gosh, I was looking at the wrong one. There it is, 5 days, 15. I was wondering why I didn't see it there. All right, so let's go back if it'll let us. Apparently it won't. Okay, how about a 180-day, 4-hour one? And that's not really going to give us much because it's still 4 hours per candlestick. There, 1 hour, 20 days, 1 hour. All right, so here it is, right there. So let's go ahead and just take a look at just this day right here. There we go. All right. So I remember this day very, very well. I was watching the premiums all day long, and I kid you not when I say this, the costs of 0 days till expiration premiums on these options contracts at about 1 o'clock my time, so 2 o'clock Eastern time, which, you know, you're literally only looking like 2 hours from the market closing, were basically the exact same as when the market opened. Now, why is that? Well, everybody knew Powell was going to be talking, and nobody was willing to change what they were wanting to sell their options contracts for until he started talking. So when it opened up, let's just say, for example, there was a certain strike that was had a $2 premium. It was going to be about $2, even though, I mean, we did go down a little bit when we came back up. It was still about that same premium with only a couple hours left till expiration. It was crazy. And that's how it's going to be pretty much every FOMC meeting, by the way. And anything that causes any kind of volatility, you should expect 100% of the time for there to be crazy high premiums. That's just how it's going to be. Anytime you see, oops, I didn't want the 1 minute. Anytime you see high volatility, you're going to see crazy premiums. So anyways, I know I probably, babbled a little bit. I do apologize for that. I probably should have had the trading options network platform open already. But again, I did want to kind of just go into a little bit more detail about volatility and, what you're going to want to do when you have high volatility. The best thing to do, I briefly mentioned it, I should have talked about it more, is to be a net seller when you have high volatility. Because guess what happens? When the volatility comes back down, the premiums are going to come back down. So even though I've seen it, it's happened to me, it's probably will happen to you if it hasn't already. You may buy an options contract one day and the stock itself may go up, but the premium is going down. And why is that? You buy a call, let's say, for example, the stock price was $20 and you bought an at the money call. So you bought a 20 strike call. And then a few days later, it's $21. And let's say you bought it with plenty of time. So we shouldn't be seeing any time decay on that, okay, or theta decay on that premium. But yet the stock is now at $21, but the premium is now less than when you bought it. Why is that? Well, again, chances are when you bought that contract, the volatility was high, which caused the premium to be high. And even though over the next couple of days, the stock has moved in your direction, the premium decreased because the volatility decreased. Volatility has a huge impact on premium. On the flip side, if you were a net seller of that premium, even though the stock had gone up, guess what? You can actually buy out of that contract for less than what you paid into it, even though the stock did go up. So being a net seller when you have high volatility is usually going to be a better strategy. On the flip side, obviously, when you want to be a net buyer is when the volatility is a little bit lower. Now, don't get me wrong. Can you make money when volatility is high and be a net buyer? Of course you can, but you actually have to have that stock move in your direction and move significantly. If it doesn't move a lot, then ultimately you're gonna get crushed by that volatility. But in the grand scheme of things, there's so many different ways you can make money with options. It's a great opportunity, but again, my tip of the day yesterday was use options volatility, or use the IV, why am I brain farting right now? I can't think of the word. The implied volatility. Use implied volatility to your advantage and know when and how to use implied volatility and when to be a net buyer, when to be a net seller, so on and so forth. So I'm going to close it out here. Again, the market looks like it's still kind of just doing pretty much nothing today, and I'm not surprised. Keep an eye out for my stock of the day and my tip of the day later on today on my social medias. And whatever my tip of the day will be later today, you should expect to see a little bit more of a training on that tomorrow. So I hope you guys all have a great rest of your afternoon, and we'll talk to you